Hey everybody, this is Pat Jennings again from thebizseller.com, and this is the next video in our series where we answer the most often asked questions about business valuation. And in this video, we're going to answer the question, what does recasting financial statements mean? Or what are recast financial statements? Now, if you're like most business owners, you have run your business, at least to an extent, in a way that minimizes your taxes. Maybe you've kept a family member on the payroll at an overly generous salary, or you've had the company make the lease payments and the insurance payments on your car. And now these perks and benefits that you've received from your business, they're all of real value and have been paid for with the revenues generated by the business, but they've been deducted from the profits before figuring your taxes. So now that you're going to prepare the business to sell, you need to go back and create a new set of financial statements where you can demonstrate to your buyer the true value that the business generates for you as the owner. So creating a set of recast financial statements is the way that you can add the value of all these benefits back into your financial statements. Now, recast financial statements don't replace regular financial statements. They're in addition to them. And you always want to make sure that the buyer understands which they're looking at. The list of expenses that may be recast can be quite long, and it's going to vary from one business to another. But here is a list of some of the more common expenses from the income statement that might need to be recast. Owner's salary. You want to deduct from your expenses the owner's salary and benefits, plus deduct all the expenses associated with the owner's perks, automobile lease and insurance, retirement plans, profit sharing, and then add back onto the income statement a reasonable salary to pay for a manager to replace you. You may determine that the going rate for someone to manage your business is, let's say, $80,000 a year. But with your salary and benefits and perks, you've actually been paying yourself $120,000 a year. Well, that's $40,000 in benefits you received that don't show up as profit. The new owner wants to come in and hire somebody to do your job, the job you've been doing, managing the business day to day, and he can hire that person for $80,000. Well, that's $40,000 in benefits he's going to receive that he's not going to see on your tax returns. Next, when applicable, you want to deduct the salaries of any family members who are on the payroll but will not remain after the sale. Now, if the family member actually did enough work that they're going to need to be replaced, again, you want to add back in a reasonable salary for a replacement employee to do the job that they've been doing. Next, you want to deduct any one-time expenses that the new owner will not need to pay, such as an unusually large and hopefully one-time equipment purchase, things like legal fees that are associated with a lawsuit that have been settled. And also, you want to deduct from your expenses any costs associated with preparing the business for sale, because the new owner hopefully isn't going to have to worry about that for a while. Now, to make your recast statements more accurate, though, you are also going to have to deduct from revenue any one-time payments, such as proceeds from an insurance claim, sale of a piece of real estate. If you were involved in a lawsuit and you won and you received a payout, the sale from the real estate, the revenue from the insurance claim or the lawsuit, that's not going to occur in the next year and the year after. So those things have to be removed from your income. And lastly, you want to deduct interest payments on any business loans that you're going to pay off. On the balance sheet, you want to remove all assets that are not going to be included in the sale. Again, that car that you've been paying for, maybe you want to keep that. Maybe it's paid and you want to keep that. Well, that's not really a benefit then to the new owner. In most circumstances, certainly the existing owner, the seller, is going to take the accounts receivable that have already been earned with them. So any assets that you're taking with you on your recast balance sheet, remove those assets. Okay, remove all debts that will not be assumed by the buyer. You want to remove all damaged obsolete, slow-moving inventory, and value the remaining inventory at replacement cost. And just like inventory, you want to remove all old, obsolete equipment that you haven't used in 20 years, but it's still sitting around. Because when the buyer comes in and sees it, they're not going to want to pay for it. So do yourself a favor, and all that inventory and all that equipment that you've written off in your mind, write it off on paper too. And lastly, write off all accounts receivable that you know are going to be uncollectible. You may have had a good long-term customer who's fallen on hard times and they've owed you money for the past year. Well, if they haven't paid you, they're probably not going to pay the new owner either. So those accounts receivables that are dead and buried, just acknowledge that and write those off. Now, you and your accountant, you're going to have to go over your income statements and your balance sheet looking for any and all items that you can legitimately recast. And it's okay to be aggressive with your recasting. Listen, if the buyer has owned a business before, they're going to understand what you're doing. He or she has probably done the same thing when they sold their business. In fact, I can guarantee you they did the same thing. And again, let's just be clear, your recast statements don't replace your regular financial statements. They're in addition to your regular statements. So there's nothing tricky going on here. There's nothing underhanded or sneaky about this. Again, let them know when they're looking at the recast statements that they are recast statements. And take the time to note your reasoning for each recast item. Be able to defend it so that you want to be in a position where you can make a convincing case to the buyer why you've recast a certain item at the level that you have. While buyers understand the need to recast financial statements, that doesn't mean that they're always going to agree with every item that you've recast. So you need to be prepared to compromise and negotiate on certain items. For example, we talked about adding back in a quote-unquote reasonable salary to hire a manager, or a reasonable salary to replace a family member. Well, how you and the buyer define reasonable is probably going to differ, at least slightly. And that's the example of the type of thing that you may have to negotiate with the buyer. Now, if you have a question specifically about your circumstances, about the valuation of your business that you're preparing to sell, you can leave a question down in the comments section. And in future videos, we're going to address the more commonly asked questions. And until that video, I will see you then.